Hello, everyone, and thank you for listening in. Today, we'll be reviewing our investment outlook for Northrop Grumman. Our team conducted a full valuation utilizing EBITDA DCF and perpetuity DCF models alongside operational and key risk analysis. Based on our findings, we are indicating coverage on NOC with a buy recommendation. Before we begin, I would love to introduce our team. My name is Annie Georgian, and I will be going into the brief background as well as the key risks with NOC. Mark Bennett will then go into our competitors as well as the SWOT analysis, and Rob Remington will conclude with valuation methods and our final overall recommendation. Let's go ahead and get started. So what exactly is Northrop Grumman? Northrop Grumman, otherwise known as NOC as its ticker symbol, is one of the largest and most diversified defense contractors in the United States at the moment. Operating across several different programs such as aerospace, mission-critical defense programs, and space systems, NOC consistently produces around $40 billion in annual revenue. Its long-term government contracts and significant backlog provide predictable cash flows as well as strong visibility into future performance. At the moment, NOC trades at around $572.25 with a market cap of $81.7 billion. This positions NOC among one of the largest firms globally, supported again by its strong government relationships, recurring contracts, and mission-critical programs. So our team here is initiating a buy recommendation on NOC. At the current share price of $572, our EBITDA DCF valuation, which we view as our implied floor price, points to a conservative target of about $626.77. This offers about 9.5% upside based on today's market level. This approach reflects a restrained, operations-driven estimate of a value. To complement this, our perpetuity growth DCF utilizes a 3% terminal growth rate as well as a 7.11% WACC, producing an implied ceiling valuation of $1,477.77, or about 158% upside. This scenario captures the longer-term value creation potential embedded in NOC's defense programs and broader industry positioning. We also note that the 12-month high estimate of about $635 aligns with the direction of our valuation work and provides an external reference point supporting the upside case. Taken together, both our conservative and long-term valuation methods converge on values substantially above the current trading price, which is extremely significant. This consistency across methodologies strengthens our conviction in a buy recommendation for NOC. Mark will now go into the SWOT analysis as well as key competitors.
This is the management team currently for Northrop Grumman. It is led by the CEO, Chair, and President, Kathy Warden. Ken Cruz is the current Chief Financial Officer, who is soon to be replaced in January by John Green. Melanie Heckkamp is the Chief Human Resources Officer. Catherine Simpson is the General Counsel, and Travis Garis is the Chief Information and Digital Officer. The company is structured into 4 core business sectors that develop aerospace and defense equipment, led by the following corporate vice presidents and presidents. Tom Jones leads the aeronautics systems sector. Dr. Robert Fleming leads the space systems sector. Ben R. Davies leads the defense systems sector, and lastly, Roshan Roeder leads the mission systems sector. Our key competitors in the industry are Boeing and Lockheed Martin. Boeing and Northrop Grumman compete for aircraft government contracts, where Boeing produces fighter jets such as the F-15 and transport tankers such as the KC-46 Pegasus tanker. Meanwhile, Northrop Grumman produces bombers such as the B-21 Raider, B-2 Raider, and unmanned systems such as the RQ-4 Global Hawk. Northrop Grumman and Lockheed Martin compete for contracts in the Missile Defense Next Generation Interceptor program and in air defense command and control systems. All three do compete for contracts for national security space missions, such as for NASA satellites and commercial space exploration programs. In 2002, Northrop Grumman did win a contract and was the prime contractor to work on the James Webb Space Telescope. For our SWOT analysis, I do want to cover the major item for each category. For strengths, Northrop Grumman has a significant amount of revenue coming their way from the backlog of contracts. For weakness, they are overlying the U.S. government, where about 87% of the revenue comes from the U.S. government and can be affected by U.S. government shutdowns. For opportunities, they can create relationships and defense contracts with NATO members where they currently do not have a presence at this time. And for threats, they face legal and regulatory litigation and claims, such as one where the U.S. sued Northrop Grumman for improperly charging hours on a contract. From our Porter's Five Forces analysis, we gave competitive rivalry a high rating, which is due to a few competitors in the industry, such as Boeing, who compete in contracts with aggressive bids. We also gave consumer power a high rating as well because the buyer is the U.S. government. It is Northrop Grumman's primary source of revenue, and the U.S. government has the power to bargain over its contracts. We gave supplier power the rating from medium to high because Northrop Grumman needs specialized parts and raw materials from vendors to make its products, and supply chain issues can cause delays in making those products. We gave threat into entrance a low rating due to the capital needed to set up, strict regulations that need to be followed, as well as customer preferences. And lastly, we gave threat a substitute a low rating, which is due to specialized contract programs that are mission critical, which can run for decades, and there are no real cheaper substitutes for them.
Good afternoon, everybody. Here's our valuation framework. Using both models gives us a market-based and a long-run view of value. With our conservative base, the EBITDA model gives us a $77 billion enterprise value, and the perpetuity model gives us a $202 billion enterprise value. Using both models lets us cross-check and provide a better overall range. Looking at this sensitivity table shows that even under conservative assumptions, higher WACC and lower growth, NOC's implied value stays above today's market price. At our base conservative case of a 7.11% WACC and 3% growth, we get an implied value of $1,477 per share, reinforcing strong upside with limited downside. Here's the 5-year stock comparison with two major competitors. NOC shows a steady, consistent upward climb. Lockheed grows, but with more volatility. And Boeing's chart looks more like a heart attack victim. The market's clearly signaling greater confidence in Northrop Grumman. Here's the 5-year growth breakdown. Northrop is a plus 78, Lockheed a plus 24, and Boeing an anemic negative 4. That gap isn't luck, it's structural. Northrop Grumman's diversified, higher-margin segments drive growth. Lockheed is tied heavily to the maturing F-35, and Boeing continues facing manufacturing issues, bad press, regulatory scrutiny, and slower-than-expected aviation industry. Here's where the rubber meets the road. Here's where the valuation range comes together. We used a conservative 10x multiple, while other analysts use 14 to 18x for high-quality defense names. Even at 10x, NOC shows strong upside. When you move toward what other evaluators are using as standard multiples, 16 to 18x, the implied value easily exceeds 1,000 per share. Across all reasonable assumptions, NOC stays well above market. Operationally, NOC keeps strengthening. Margins and returns remain solid, and receivables turnover improved drastically. This level of cash efficiency appears to be elite compared to their competitors and positions NOC in a high value spot ahead of this next defense cycle.
Despite our strong outlook, our team has identified several risks that we have taken into consideration when providing our recommendation for NOC as a buy. NOC is heavily dependent on government contracts and government defense budgets, which could be affected by government shutdowns or even policy shifts. To add on, supply chain challenges and rising material costs may put additional pressure on margins. NOC also does operate under very strict defense contracting rules where compliance issues can lead to contract modifications or even penalties. Finally, competitive pressures and changes in global conflict levels may also impact future growth, so this is something to take into consideration. These risks do not outweigh the upside potential, but we should take into consideration and monitor closely. Robert will now go into our final conclusion.
So here's our final call. Across all methods, Northrop Grumman shows a conservative upside floor of around 11% and a bull case upside reaching 158%. And no valuation scenario, Not even our worst case scenario places the stock below the current market price of $572. Combine that with strong financials, improving efficiency, unmatched program transparency, combined with a global geopolitical arms race and an administration that just titled the government agency the Department of War, meaning defense spending, improvements, and capability is prime objective while this administration holds the keys to the castle. We rate Northrop Grumman a strong buy. And honestly, given where defense is heading, the only question you have to ask is whether NOC becomes a nice asset in your portfolio or the stock that buys you the big boy toys.